Good afternoon. Central Bank of Nigeria Communique number 87 of the Monetary Policy Committee meeting of Monday, January 21st, 2013. The Monetary Policy Committee MPC met on January 21, 2013 with 10 out of the 12 members in attendance. The committee reviewed the domestic economic conditions in 2012 and the challenges therefrom against the background of the international financial and economic environment in order to chart the course of monetary policy in 2013. The international economic situation. The committee noted that global economic growth remained largely uneven and subdued in most economies in 2012. Latest data from the IMF indicates that global output was weaker than previously forecast due to continued contraction in the Eurozone and Japan, as well as the less than anticipated growth in Brazil and India. The fragility in the global economy was further compounded by the uncertainty surrounding resolution of the fiscal cliff and debt ceiling challenges in the United States, and the difficulties associated with China's attempts to rebalance its growth. These developments adversely affected private sector confidence, worsened the unemployment situation, and further tightened financing conditions in both periphery and core economies. Although the European Central Bank, ECB, attempted through its intervention scheme to halt the downward trend in economic activities in the zone, the effort did not record much success. Overall, global output was estimated to have expanded by 3.2% in 2012 against the earlier projection of 3.3% made in October 2012 IMF World Economic Outlook. Growth in the advanced economies was estimated at 1.3% in 2012 and projected at 1.5% in 2013, reflecting a revision of 0.2 percentage points from the initial estimates. The committee noted that the decline in global investment was mainly traced to the fiscal standoff in the US and its implications for the paltry expansion of 2% in output in Q3 2012. Emerging European economies, which had previously shown signs of strong rebound in credit crisis, have now been hit hard by slow export growth and a halt to real GDP growth. On the whole, the committee is of the view that while the decision of the ECB considerably reduced the probability of a Euro-wide financial crisis, the condition of country-level financial systems remain difficult and could constitute a significant challenge to output expansion in 2013. Latest data from the Asian economy suggests that a gradual recovery may be underway. China's economy, which had previously reported a slowdown over 7 consecutive quarters to Q3 2012, witnessed improved economic activity in Q4 2012. Recent fiscal and monetary easing operations have increased investment in infrastructure, with signals of further spending into 2013. The Indonesian economy, after recovery from the severe flooding in 2011, continued to show resilience against the global slowdown as investment and strong domestic demand contributed to growth. It is expected that these twin drivers would further sustain output expansion in 2013, although recent reports indicate that severe flooding has once again hit the economy during this month. The suboptimal performance of the Japanese and Indian economies, however, was a major drag on the recovery in the region. The Indian economy was hampered by slow approvals for new projects, deterioration in business sentiment largely due to the rising current account deficit, uncertainty over the sale of government stakes and state-owned enterprises, fiscal deficits, depreciation of the rupee, and a high debt burden, as well as a slow implementation of structural reforms. Japan's drawback was likely due to a combination of declining exports and sluggish domestic demand. There are, however, expectations that the growth decline will bottom out in 2013 as anticipated rebound in major trading partner economies like China and US will translate to a recovery in the demand for Japanese goods and services. The MENA region continued to record mixed performance, evidenced by the between economies of the oil exporting and oil importing countries. Oil importing countries experienced subdued economic performance with an estimated growth of 2% in 2012, while all exporting countries grew at an average rate of 6.6%. Growth in all exporting countries was driven largely by high oil output and prices, coupled with the early post-conflict recovery of Libya. Economic conditions in sub-Saharan Africa remain generally robust despite the sluggish growth in the global economy. Prudent policies and improved fundamentals in most countries provided additional impetus for increased economic activity in the region. The committee noted that the main risks to the outlook for the region come from their trading partners, including the possible intensification of financial stress in the Eurozone and a sharp fiscal adjustment in the United States. In light of the uncertainty about the direction of fiscal policy in the US, particularly with regard to the yet-to-be-resolved issue of debt ceiling and the persisting Eurozone financial economic crisis, the committee was of the view that the global economic environment was still fragile and highly vulnerable to a further contraction, although the downside risks appeared to be less severe relative to conditions in the last 2 years. Domestic economic and financial developments. Output. The National Bureau of Statistics projected real gross domestic product growth rate at 6.61% for 2012, which is lower than the level recorded in 2011 by 0.84%. The estimated real GDP growth rate at 7.09% in the fourth quarter of 2012 was higher than the 6.48% in the third quarter, but lower than the 7.68% recorded in the corresponding period of 2011. The non-oil sector remained the major driver of growth, recording 8.23% increase in contrast to the oil sector, which contracted by 0.17% during the period. The committee expressed concerns about the continued decline in the contribution of the oil sector to growth due to lower production relative to the corresponding period of 2011, and enjoined the federal government to fast-track the passage of the PIB to halt the trend by attracting new investments into oil exploration and production. The relatively robust growth projections, despite the slowing global economy, reflected the relatively robust performance of wholesale, retail trade, and services sectors, outcome of the banking sector reforms, initiatives by government to stimulate the real economy. Despite the developments in the international oil market, where the US is now the second largest oil producer, the committee observed that the growth projection remained promising, anchored on the recent improvements in power supply. The committee noted with satisfaction the federal government's efforts to sustain the current initiatives to boost power generation, particularly the progress made in reforming the power sector. The committee, however, observed that the severe flooding in several parts of the country in 2012, which damaged housing, agriculture, and oil assets, will pose downside risks to growth and feed into food supply deficits and inflation in the near term. Also, the continuing security challenges as well as delays in the reform of the oil sector will undermine investor confidence and output growth in the near term. Prices. The committee observed that on average inflation pressure was elevated in 2012. The year-on-year average headline inflation rate in 2012 stood at 12.24%, while the average core and food inflation year-on-year stood at 13.87% and 11.32% respectively. The major drivers of headline inflation in December included food and non-alcoholic beverages, housing, water, electricity, and transport. The pickup in food inflation in the latter part of 2012 was accounted for by imported food items and food shortages due to the impact of flood on farmlands along the major agricultural belt in the country. However, the committee was of the view that the pass-through effect of imported food inflation to domestic prices may have been subdued owing to the relatively stable exchange rate during the period under review. Monetary, credit, and financial markets developments. Broad money supply grew by 13.72% in December over the level at end December 2011. Aggregate domestic credit grew by 1.98% in December 2012, which was substantially below the benchmark of 52% for the year. Credit to government contracted between September and December, occasioned by the sustenance of government as a net creditor to the banking system, reflecting more prudent fiscal measures, including the introduction of the Treasury single account. Interest rates in all segments moderated between November 19th and January 3rd, 2013. This reflected increased liquidity in the banking system, including release of statutory revenue to subnational governments, absence of repo transactions during the review period, repayments of matured CBN bills, and banks desire to maintain optimum liquidity position on their balance sheets at the end of their common financial year. The interbank call and OBB rates, which were at 13.99 and 13.95% on November 19, 2012, closed at 10.32 and 10.45% respectively on January 3, 2013. The average interbank call and OBB rates for the period were 11.09 and 11.03% respectively. The average prime lending rate increased slightly to 16.54% in December from 16.48 and 16.51% in October and November 2012 respectively. In contrast, the average maximum lending rate fell marginally to 24.61% in December from 24.65 and 24.70% respectively in October and November, while the weighted average savings and term deposit rate decreased to 5.50 in December from 5.57 in the preceding month. The committee therefore encouraged the bank to fast-track the financial inclusion strategy to improve financial intermediation and effectiveness of the transmission mechanism of monetary policy and to adopt ways of moderating the high spread between deposit and lending rates. The committee observed that the rally in the Nigerian capital markets continued as equities market indicators trended upwards in the review period. The all-share index increased by 35.45% from 20,730.63 to 28,078.80 between December 30, 2011 and December 31, 2012. Market capitalization also increased by 37.38% during the same period. The positive performance of the all-share index and market capitalization was due to the sustained increase in demand for blue chip stocks, particularly in the banking and consumer goods sectors, following improvements in earnings, completion of the banking reforms, and growing investor confidence. The committee, however, noted that a significant factor responsible for the recovery is strong portfolio inflows from abroad, and cautioned that the capital market remains structurally vulnerable to external shocks until its funding base is changed. External sector developments. At the WDAS, the exchange rate opened at 157.31 naira to the dollar on November 20, 2012, and closed at 157.33 on December 31, 2012, representing a depreciation of 2 kobo, or 0.01%. The average WDAS exchange rate during the period was 157.32. At the BDC segment, the selling rate opened at 160 naira on November 20 and closed at 159 naira on December 31, representing an appreciation 159.5 on December 31, representing an appreciation of 50 kobo, or 0.31%. At the interbank segment, the selling rate opened at 157.95 on November 20 and closed at 156.25 on December 31, representing an appreciation of 1 naira 70 kobo, or 1.08%. Overall, the relative stability recorded in the foreign exchange market will be attributed to the combined effects of improved supply of foreign exchange by all companies and enhanced inflows from portfolio investors during the period under review. Also, all revenue increased at an average of 2.73% monthly throughout 2012. In the first 11 months of 2012, all receipts totaled $40.087 billion. The committee noted with satisfaction that the premium between the WDAS and interbank rates was narrowed towards the end of the review period. However, the premium between WDAS and BDCs widened towards the end of the period, suggesting the need to sustain further complement existing measures to discourage speculative activities in the foreign exchange market. In general, the committee noted that exchanges at previous MPC meetings were yielding desired results in this market. The committee expressed satisfaction with the sustained accretion to external reserves, which stood at $43.849 billion as of December 31, 2012, representing an increase of $1.682 billion, or about 3.98% from the level of $42.167 billion at the end of October 2012. Relative to the end December 2011 level of $32.915 billion, external reserves as at the end of December 2012 had risen by $10.934 billion or 33.21%. The increase in foreign reserves level was driven mainly by proceeds from crude oil and gas exports and crude oil-related taxes, as well as reduced funding of the WDAS on account of the huge inflow of foreign portfolio investments, which is about 77% of total inflows through the CBN. The foreign reserves level could finance about 9 months of imports. The committee's considerations. The committee observed that the performance of the global economy remained largely subdued and is characterized by uncertainty and contraction in the Eurozone and Japan, as well as lower than expected growth in the large emerging and developing economies. The committee notes with caution that the partial resolution of the fiscal cliff in the US offers some hope for gradual global economic recovery, as indicated by the rebound of many global financial markets in the wake of the staving off of automatic tax increases and expenditure cuts on 1st January 2013. The committee further observed that the robust prospects for energy independence of the US could pose downside risk for global oil prices in the medium to long term, which could threaten fiscal sustainability in many oil-dependent economies around the world. The committee noted that in spite of the slow progress made in the resolution of the Eurozone crisis, the prospect of recession had not yet been completely averted in the near term. Developments in the domestic economy in the past 3 months highlighted some new pressure points to macroeconomic stability. The committee is of the view that shocks to the economy could come from a significant fall in the demand for oil, leading to a fall in oil prices and government revenues, weaker exchange rates, rising inflation pressures, and a depletion in external reserves. The committee also noted the drop in headline inflation in December 2012, although it also recognized that core inflation had risen, driven mainly by cost-push factors, even in the face of sluggish growth in monetary aggregates. With regard to the budget of the federal government, the committee cautioned against complacency with regard to government revenue, despite the high level of oil prices. The committee noted uncertainty in global demand and supply of crude oil and weak performance of non-oil and VAT revenues. The committee, however, noted with satisfaction the efforts of the federal government aimed at keeping deficits within the threshold prescribed by the Fiscal Responsibility Act and advocated sustenance of this effort. On expenditure, the committee noted that there was still the need to continue to drive down recurrent expenditure in favor of capital expenditure in view of the infrastructure deficit that has continued to constrain growth performance. The committee noted that the oil price benchmark for the 2013 budget, which was increased from $75 to $79, may pose a downside risk to inflation objective and therefore constituted a pressure point for the low inflation objective and effective monetary policy as a whole in 2013. The committee reaffirmed its commitment to respond appropriately if public spending in 2013 ultimately adds to inflationary pressures. In view of these developments, the committee was faced with 3 choices. 1, an increase in the NPR in response to the higher oil price benchmark for fiscal 2013 and anticipation of higher government expenditures. 2, a reduction in the NPR in view of declining GDP growth trajectory and benign headline inflation. And 3, retain the current monetary policy stance in view of the conflicting price signals and global uncertainties and the need to preserve the stability of the system. The committee's decision. Given the stability achieved in the last 12 months, with average year-on-year headline inflation rate at 12.24% in 2012, the NPR of 12% is considered to be at just about the right level. The committee considered the calls for a reduction in the NPR because of the benign inflation outlook, other things being equal. However, this outlook may be undermined by increased subnational government spending and federal government expenditure in 2013, the higher benchmark oil price in the 2013 budget, and adverse developments in advanced economies with possible impact on oil prices. In view of the foregoing, the committee decided that it was prudent to hold and monitor developments between now and the next meeting of the MPC. The committee therefore decided by a vote of a majority of 8 to 2 to maintain the current policy stance. That is, retain NPR at 12% with a corridor of plus or minus 200 basis points around the midpoint, retain CRR at 12%, and retain equity ratio at 30%. 2 members voted for a reduction in NPR by 25 basis points. Thank you.
These questions, please identify yourself and the media house you represent. Next person should come directly behind you.
Good evening. My name is Onyo Machkora for Business and Newspaper. So last week, the over 200 BDCs, with the operating licenses of over 200 BDCs, were revoked, and no specific reasons, were given for that action. Please, would like to know one. Secondly, last year you said, that the CBN would consider the cash sales of dollars to BDCs to sort of check the dollarization of the economy. We'd like to know how far you've gone with that plan and when we'll probably see this happen.
Okay, well, 2 things. Do you want me to give you the reason for each of the 200 BDC licenses revoked? We revoke licenses when the operator does not meet the conditions of the license. And there are a number of conditions. A number of them, for example, did not make the mandatory deposit payments. A number of them we found had closed since, and we didn't seem to find their addresses. And so for each of them, there was a reason, and each of them knows the reason why the license was revoked. The cash sales, yes, we are very much committed to the de-dollarization of the economy. But before we stop the import and sale of cash dollars, we have to provide alternatives. So we're looking at a number of options, including partnering with companies to make sure that people begin to use cards and load whatever they want on cards. We're also going to make sure that for all these expenses for education, for health, people make electronic transfers. So you don't just stop it, and you remember you wanted to have a 5,000 naira note, which would have helped again with the movement of large amounts. That has been stopped. So that's back a little bit. But we are working on a policy, and guidelines will come out. We certainly think that there is no need in this economy for people to be transacting in dollar cash. I would like to ensure that when you purchase dollars, it's for transactions outside Nigeria, and then we find a way of getting it on.
Next. Please come this way if you want to ask questions.
CBN Governor, sir. The position of the MPC to return the 12% of Cliff IOZ report for NTM is 24. The position of the MPC to return the 12% monetary policy rate has its implications on the lending rate, and will no doubt affect the present government drive to ensure that the small and medium enterprises, get into more business, have the right funding to open up the space for employment. Considering this fact, what are your expectations, possibly in the near future, on how this could be redressed? Thank you very much.
Well, I've made this point before. You cannot have low interest rates in a high inflation regime, high inflation environment. And our ability to bring down rates is a function of our ability to do that and maintain price stability. We should not underestimate the impact of instability on the SMEs. That's one. The second thing is I've also made the point that question of access to finance goes beyond rates of interest. There are many other costs. You've got power, you've got infrastructure, you've got security, you've got access to markets, and it doesn't make sense to just blame high interest rates for SMEs not getting access to credit. But the last 1 year we've kept inflation in check despite global and local turbulence. We have kept exchange rates stable despite social insecurity and global and an uncertain global environment. We have built up reserves. The stock market is recovering. We do not want to take that for granted. And while we do understand that everybody wants rates to come down, the government wants rates to come down. We do understand that. But the central bank is primarily here to provide stability, and we will continue to maintain rates at whatever level we consider consistent with our price stability mandate.
Mr. Governor, I present the motion here. You just mentioned some of the things I wanted to ask you, but I just want to ask again, when do we hope to see the rates being relaxed? The foreign reserves high now than the last meeting in November of last year, about $40 billion last September, aggregate demand, capital markets improving, a whole lot of things. When do we hope to see the rates being relaxed? Are you still going to be hawkish with all these improvements and inflation trending downwards?
I don't like, I don't know whether I'm being hawkish or all these words. Look, inflation is about 12%. NPR is 12%, which is about right. Core inflation has been averaging about 12%, but we do expect in January to see a moderation in inflation, largely because of base effects on the fuel subsidy removal in January this year. We'll see what inflation is like January, February, March before the next MPC meeting. I'll look at the output and the outlook of international